You know that feeling?
Yeah.
Late at night, maybe, and your mind's just racing.
Mm.
And somehow it always lands on money worries.
Oh, yeah. Happens to everyone, I think.
Whether it's, feeling the pressure to earn more or just trying to save or even just making sense of it all, it can feel like a lot.
Totally overwhelming sometimes.
Well, someone shared a really interesting source with us, Paul Podolsky's The Uncomfortable Truth About Money. And we're going to really dive into it today.
Yeah, cut through some of that noise.
Exactly. The goal here is for you to walk away feeling like you really get the key ideas, but without that, brain-fried feeling you get after trying to cram too much financial info.
Right. No marathon needed. So our mission, really, is to unpack those core truths Podolsky talks about. It's not just numbers and charts, is it?
No, not at all. It's the emotions behind it, the societal stuff that shapes how we even think about money.
And what's really interesting is where he starts. It's super personal, something I think a lot of people can kind of connect with.
Oh, yeah, that rat episode he describes in Brooklyn back in '97.
Vivid stuff.
Imagine standing there with your, 3-year-old kid and just watching rats wandering between your building and a pile of garbage. Ugh.
Yeah, not exactly ideal.
For him, it was this huge wake-up call. Boom, money isn't abstract anymore. It's directly linked to giving his family a better, safer place to live.
It grounds it immediately, doesn't it?
Yeah.
That basic human drive for a better life makes finance feel, real.
Definitely. And right away, he sets up this really broad idea of what money even is.
Yeah, it's not just like the cash in your pocket.
No, it's credit. It's different currencies all over the world.
And he links it to everything, really. Basic needs: food, shelter, but also the wants,
Yeah.
the stuff that's nice but maybe not essential.
And then he brings in this concept he calls the money cage.
Okay, yeah, let's get into that. The money cage.
So the way he describes it, money can sort of contain us, not just physically, dictating where you can afford to live.
Right, but mentally too.
Exactly. Fueling all those worries, the anxiety. And the key thing about this cage, he says, is figuring out which bars are actual real limits.
And which ones are just in our heads.
Yeah.
Self-imposed anxiety.
Precisely. And understanding that difference, that's step one to feeling more in control, maybe.
Makes sense. So understand the mechanics of the cage.
Yeah.
How money actually works.
Yeah. And then hopefully you can make more rational decisions, separate the feelings from the facts a bit, and maybe, just maybe, feel a little less anxious about the whole thing.
Yeah, lower the anxiety levels.
Right.
But he's also super clear from the get-go, right? There are no simple answers here.
Oh, definitely not. No magic bullets. It's always about trade-offs. Constant trade-offs.
And that really rings true, I think. Because worrying about money, it's not like it's a new thing.
Not at all. People have been wrestling with this stuff for, forever. It kind of helps knowing you're not alone in it,
Absolutely. Which makes it even weirder, doesn't it? How secretive we are about it.
It is weird. He points that out. People share incredibly personal stuff online, relationships, health issues.
Everything.
But bring up money. Salaries,
Right.
savings. Suddenly it's like Fort Knox.
Yeah, the shutters come down. And he suggests it comes from this basic insecurity, right? Whether you feel like you have too little.
And worry it's some kind of personal failing.
Or even if you have a lot. Maybe you worry about being judged or people asking you for money all the time.
It's definitely an uncomfortable truth, like the title says.
Exactly. Which leads us to this core tension he explores. This balance between, what does he call it, reverent awe and practical reality.
Okay, awe versus reality. Tell me more.
He gives this beautiful example from his childhood, a memory. At a salt marsh, Woods Hole, with his mom.
Sounds nice.
Just a simple moment. Wet sneakers, the smell of the brackish water, just pure wonder. Completely outside of money, No cost, no value attached.
This is a lovely image, pure experience.
And then he just slams you with the contrast. A totally practical, very real problem.
Which?
Needing to find $2,000 in crisp $100 bills to basically bribe doctors in Moscow for his son's birth.
Whoa, okay, yeah, that's a contrast from the salt marsh to bribing doctors.
Huge jolt, right. And he says that rat episode later just hammered home the need to focus on the practical side of things.
So how does that contrast illustrate the role of money?
Well, he uses it to talk about money as a kind of shackle. It ties us, tethers us, to those practical realities: rent, bills, health stuff.
Things you can't just ignore.
Exactly. Maybe when we're younger, we act like that tether isn't there, but it always is, mortality. And he makes this really sharp point.
Yeah.
Even people with tons of money, the super rich, They could lose their way if they get too detached from those basic realities.
Huh, that's grounding, isn't it? Even vast wealth doesn't let you totally escape the fundamentals. So how do we navigate that tension then? Seems like self-awareness is key.
Absolutely. He talks about finding your spot in life, which sounds maybe a bit huge and vague.
Yeah, a little intimidating.
But he boils it down. Pretty simple, actually. You get paid when you do something other people need or value.
Okay, meet a need.
And your wealth grows if you consistently spend less than you bring in. The real challenge, he says, is figuring out what you can offer. What do people actually need from you?
Right, aligning your skills with what the market, demands. He tells that story about the older woman and the rolled up paper, like a telescope.
Yeah, that's a great metaphor for focus. She was telling him to connect his interests, hobbies, things he just does without thinking.
Stuff you're drawn to anyway.
Exactly. Connect those things to generating, well, positive cash flow. He uses skateboarding as an example.
Skateboarder.
If someone loves skateboarding, what's underneath that? Is it freedom, physical activity, the gear, the community? Understanding those drivers can help you find a way to earn money, do something you actually, care about.
So it's not just chasing the money, it's finding that sweet spot where your interests meet what people will pay for.
That's the idea. Now, he does lay out the basics. This sounds simple.
Yeah, what are those?
Spend less than you earn. Get the best job you reasonably can. Invest savings simply, cheaply stocks, bonds. Avoid the big wealth destroyers.
Like what?
Addictions, messy divorces, that kind of thing. Retire when you have enough. Share the excess if you can. Sounds easy, right?
Deceptively easy. Because life isn't that neat. And he knows that, right? He pivots straight to the messy part.
Immediately. The reality of constant disruption.
Ah, yes. Disruption.
And he stresses how inescapable it is, both the big external
It's
stuff.
economic shifts?
Yeah, historical stuff. Post-World War I changes, the long, quiet period for inflation, then bam, the pandemic. The big picture is always shifting, but also the personal stuff.
Job loss, health scare.
Exactly, stuff that hits you directly. And his point is, money helps, obviously, but it can't buy you absolute security from all that change.
That analogy he uses is great looking at stairs differently after you sprain your ankle.
Perfect, right? Your perspective totally changes based on your circumstances. And he warns us not to get complacent, not to trust that facade of solidity.
The granite columns on banks, the suits.
Yeah, all that stuff. It's designed to make things feel stable, but the reality underneath can be more chaotic. His advice, never look away.
Don't get lulled into a false sense of security.
Right. You need to actually study how the system works, understand the mechanics, the history, the psychology. Like knowing avalanche risks before you ski in the backcountry. Low probability, maybe, but huge consequences if it happens.
Okay, so if we can't control the external chaos, what can we control? What's the first step he suggests?
Step one, he says, is consciously separating the controllable from the uncontrollable.
Okay.
What you can control is mostly your mindset. What you can't control are those external disruptions. And he gets personal again here.
How so?
Talks about his mom dying young, bad luck, he calls it. And contrasts it with his dad's really calm, rational approach to things, good luck, in his view. Those early experiences really shaped his own emotional wiring around money.
Wow, so our past really casts a long shadow on our finances.
Definitely. That's why he stresses learning to think calmly, accurately.
Yeah.
About yourself, about your situation.
Easier said than done sometimes.
Oh, for sure. He points out the huge differences in where people start, mentions household wealth deciles. Our starting points can be wildly different.
True.
But the good news, he thinks, is we can learn to calm the chaos in our heads. Practical stuff helps.
Like what? Sleep, exercise.
Yeah, sleep, diet, exercise, maybe therapy, even finding meaning in religion. Ways to train your brain to see anxious thoughts as just thoughts, not necessarily reality.
It's a process, though, maybe lifelong for some of us.
Wow.
He makes an interesting point about super successful financial people, doesn't he?
Yeah, it's fascinating. He kind of speculates that some folks, Gates, Buffett, Dalio, might just be wired differently, like an innate advantage for handling money stuff, almost like an Olympic athlete's physical gifts.
Huh. Like a natural talent for staying calm under pressure.
Maybe. He even wonders if his own dad, with his steady logic, might have been undiagnosed Asperger's. So for the rest of us who feel the ups and downs more, learning to manage those jittery thoughts is crucial. especially when things get stressful.
Yeah.
Fight or flight kicks in.
Right. Recognizing when emotion is starting to trump logic. Okay, so mindset first. And then he gets into the bigger economic picture, right? This creative destruction idea.
Yeah, Joseph Schumpeter's theory. It's
Yeah.
fundamental. The economy's always changing. Old industries fade. New ones rise.
Like horses giving way to cars, now maybe cars to EVs.
Exactly. And while we might crave stability, he argues that real progress, rising wealth, actually depends on this disruption. The key takeaway for your money is you got to adapt. Keep learning. Complacency is the enemy.
He saw it himself, right? Delivering the Washington Post when it was huge, then seeing it have to adapt to the internet.
Absolutely. And he notes that trying to resist that change, like the Soviets did or North Korea does now, just leads to stagnation, poverty, even repression.
So there's always a cost, isn't there? Risk aversion has downsides, but so does too much risk.
It's a constant balance. He contrasts his dad's stable government job with the private sector. Higher potential reward, maybe, but way more instability. We all face that tension. Security versus wanting more.
And sometimes creative destruction isn't just gradual change, it's a full-blown crisis.
Yeah, he's lived through a few. Asian financial crisis, dot-com bust, '08, the pandemic. He describes how unnerving that is, seeing your savings just shrink fast.
Scary stuff.
His time working with Ray Dalio at Bridgewater seems key here. Learning to look beyond the daily headlines, understand the deeper cause and effect, asking, how does this whole machine actually work, not just reacting emotionally?
Stepping back, seeing the bigger system. He also brings up George Soros and reflexivity. What's that about?
Soros's big insight is about inherent instability. It's driven by, well, us mass psychology, waves of optimism and pessimism, and also by innovation. So reflexivity basically means our beliefs about the market can actually change the market. If everyone suddenly thinks a stock is amazing, that hype can drive the price up, even if the company itself hasn't fundamentally changed.
Ah, like a self-fulfilling prophecy almost. Herd mentality.
Exactly. You need to be aware of that herd behavior so you don't get swept away in bubbles and crashes. Watch the emotional swings in others, but try not to get caught up yourself.
Man, it's a lot to track. Your own emotions, these huge external forces. Then he throws in volatility.
Yeah, volatility is just the rate of change. Simple concept, really.
Okay.
We usually talk about it in finance, like short-term government bonds are way less volatile than, say, Tesla stock. But he says, apply that idea everywhere. Your job has volatility. Your savings, even your health.
And the danger is when they all hit at once.
That's the warning. These different volatilities can converge. Job loss, illness, market crash, all at the same time. A perfect storm. It's a reminder to think about how these different risks might interact.
Okay, deep breaths. So, acknowledging all this chaos, what's the next practical step in his framework?
Once you start getting a handle on that calm versus anxious feeling, he argues, you use the calm brain to strategize. Income, saving, retirement. And he starts with income, money coming in.
Makes sense. Got to have income first. He mentions education, certifications.
Yeah, he talks about his own college and grad school. Recognizes those credentials often give you a leg up in the job market. He even uses his grandfather as an example of how lacking formal education can really limit options.
But it's not the only path, right? He talks about his dad, the scientist.
Right. His dad seemed to know his talents early on, found his niche. But Podolsky notes his dad had other challenges, maybe related to being on the spectrum, as he puts it. Stable income, but maybe fewer social connections. Success isn't always balanced across all areas.
And his dad wanted him to be a doctor.
Yeah, but Podolsky realized it wasn't his path. That figuring out process is crucial, knowing when to push through difficulties and when to say, nope, this isn't actually for me.
Finding your fit. He also has a practical take on the education system itself.
Reminds us that even nonprofit universities are still businesses. You got to weigh the cost against the potential return. He decided against a history PhD himself because he didn't see the payoff matching the time and money.
Took him a while, he says, to figure out people would pay him to analyze stuff, explain the world, talk investing.
Finding that sweet spot again, combining his interests and skills into something valuable, which leads him to the idea of scale.
Scale. Okay, what does he mean by that?
Basically, how widely can you apply your skills? He compares a classical musician playing live limited audience versus someone using tech or film to reach millions.
Ah, leverage, reach.
Exactly.
Yeah.
But getting into high-scale jobs often means fierce competition, needing serious drive. Talent helps, sure, but it's often about ambition too.
He had a turning point moment, didn't he? Seeing someone in finance who just seemed to operate on a different financial level.
Yeah, that night in the bar with the endless beer, it was an eye-opener. Made him realize that feeling constantly broke wasn't inevitable, is partly linked to the type of work he was doing.
Interesting.
But he clarifies, scale isn't just about being big. It's about revenue consistently outpacing costs. Airlines are huge, right? Massive scale, but often low profits because costs are so high. Compare that to Google. Huge scale, huge profits.
High leverage, high margin.
Wall Street's another example he gives. He got that job offer as a currency strategist and saw the potential. Trading relatively small amounts could impact huge sums. That's scale.
Entering a field with built-in leverage.
But he also warns the landscape is always shifting. Creative destruction again.
He definitely saw that firsthand. Worked for companies that got disrupted, failed, got bought out.
Yeah, Washington Post Bank Boston. It's a reminder. High income attracts competition, which eventually pushes returns down. You have to stay vigilant, watch the changes, see the big shifts coming.
But just seeing them isn't enough, right?
Nope. You also have to figure out if that expected change is already baked into the price. Is everyone else seeing it too? Which brings him right back to the absolute basics. Understanding prices.
Prices, salary, what things cost, investments.
Yes, he argues pretty strongly, if you want to get money, you have to understand how prices work, where they come from.
He starts with demand, our basic needs. Food, water, safety.
Primal stuff, because even the toughest dictators can't stamp out basic human demand. And tech radically changes prices over time. Think communication. Letters and telegrams were slow, expensive. Now, text, emails, basically free, instant.
Huge difference, and for our own income.
We need to decide where we want to be in the money flow. Closer to the center, maybe high stress, high pay, or more on the edge predictable but maybe lower pay. He reckons it's pretty rare to find high pay and low stress together, the unicorn job. Okay, so income position. What about consumption prices? He observed that prices for most stuff we buy are driven by average demand. So if you earn above average and consume around the average, saving becomes easier.
Makes sense mathematically.
Flip side, earn below average, consume at average. You'll likely struggle. And for saving, investing, it's about understanding what drives asset prices and finding quality stuff that's maybe temporarily undervalued.
So ideally, earn high prices for your work, pay low prices for your consumption. Simple in theory.
Huh. Simple in theory is right. He also gets real about how fair prices get set, especially for labor.
Yeah, that's always tricky. What's fair?
He basically says no systems ever perfectly solve that. Supply and demand are way more powerful than regulations, usually. His example. Paying premium for a plumber on Christmas Eve. You need it, you pay it.
Needs drives the price.
He saw it in the Soviet Union, too. The state tried to equalize pay, but people still found ways to pay extra for things they really valued, like good health care. It boils down to being realistic about your market value. What will someone actually pay you?
Brutal honesty required. And for consumption, he points out another uncomfortable truth.
Yeah, the system is kind of set up so a chunk of the population will always struggle financially.
Depressing, but maybe realistic.
But the flip side is, if you are lucky enough to earn above average and you control your spending, you have a real shot at saving and building wealth. He mentions his own switch from journalism to finance.
For more security, right? Even though people maybe question it.
Exactly. Sometimes you make the less comfortable choice now for potential stability later.
Yeah.
Making those tough trade-offs.
Trade-offs again. And for saving, investing, it's also about prices.
Asset prices. Stocks, bonds, real estate. Driven by supply and demand in those markets. And here's the key thing for investing.
Yeah.
Pretty much everything known today about an asset is already reflected in its current price.
The market's efficient, basically.
Largely, yeah. So to beat the average, you need some insight about the future value that isn't widely recognized yet. Something the market hasn't priced in.
That sounds hard.
It is hard. That's why truly successful long-term investors are rare. It's not about timing the market day to day or get-rich-quick stuff. It's about long-term perspective, understanding real value.
Gotcha. So money used well gives you autonomy, lets you do what matters. But he hints there are other forces shaping prices too, less logical ones. Which brings him to castes.
Yeah, this is a really interesting, maybe unsettling concept. Castes within industries. Not based on race or ethnicity in his usage, but on money and power.
How does he define these castes?
He uses things like education level and geography as markers. Shows data on how wealth differs dramatically based on, say, having a college degree versus not, who are living in different parts of the world.
So education is a big dividing line.
Often, yeah. He points out how some jobs demand a degree, even if the work itself doesn't strictly require it. It acts like a gatekeeper, reinforcing that caste system.
And different industries have different potential, too.
Definitely. Some businesses just have less competition or more potential for scale. Think struggling industries like traditional publishing, tons of supply versus finance. He talks about moving into the banking caste himself.
And finding it different from the outside perception.
Totally. Misconceptions about how money was made versus the reality of intense pressure, high-speed transactions. It was eye-opening for him, seeing huge sums move so fast. Constant pressure.
A different world with its own culture.
Oh, yeah. Unwritten rules, different priorities, expected behaviors. And he started looking beyond basic banking, seeing where the really big money was being made.
Which led him where?
Proprietary trading desks inside banks, and eventually to big hedge funds like Bridgewater. He saw they specialized in taking calculated risks, more purely than traditional banks often did. Moving to Bridgewater was another cash shift for him. New skills needed.
Must have been intense.
He mentions tough oral exams, constant learning. But the financial rewards were significantly higher. Huge effort, though. Then after 16 years there, he shifted again. Left that world. He'd reached a level of financial security where he could prioritize other things, like creating stuff he found meaningful instead of just meeting corporate goals. His point is, understand the system, try to play games where the odds might be better, be aware of these castes, which leads right into office politics.
Ah, yes, the dreaded office politics.
He knows it makes people uncomfortable, but argues it's just reality, especially if you work for someone else. It's not just about being nice to coworkers, it's understanding the whole organization so you can actually get things done, your goals and the company's goals.
How did he navigate it in banking?
He says understand where the money comes from, the revenue generators, and align yourself with that, and figure out who makes decisions about promotions, bonuses. Build relationships with those people.
Makes sense. He learned the hard way sometimes.
Yeah, tells a story about being undermined early on because he didn't understand the hierarchy, the unspoken power stuff. Painful lesson, but valuable. Play politics poorly, and you can get hurt.
So it's about awareness, understanding power dynamics, and personalities, too.
Absolutely. He compares it to bird watching, cataloging different types. Everyone has strengths, biases, quirks. He uses Obama learning golf and poker to build relationships as an example.
Smart.
Podolsky tried to understand his boss's interests, find common ground, and learning to read tells subtle cues about what people are really thinking or feeling. And managing your own tells.
And leverage. How does that build?
It grows over time. Experience, expertise, relationships, and that all increases your value. And strengthens your hand in salary talks, career moves. As you get more senior, you often get better info too, like salary benchmarks. Powerful stuff.
But there's a flip side to getting paid more.
Yeah. Paradoxically, the higher your salary, the more the company saves if they let you go. Creates a different kind of vulnerability. He concludes it's often more like high school dynamics than pure college meritocracy. The best players think strategically about it.
Okay, so you get the job, navigate the politics, hopefully save some money. What's the very first thing to do with those savings?
First step, he insists, is not investing. It's building an emergency fund. Bad stuff happens, often more than we think. You need a buffer.
Right, the unexpected disruption fund, what should it cover?
Basic living costs, buffer for potential job loss, big unexpected purchases like car repairs or home stuff, medical emergencies, the works.
Which leads to the risk-free position.
Risk-free position, what's that?
It's the part of your money you deliberately don't expose to market volatility stocks, long-term bonds. This emergency stash needs to be in something genuinely risk-free, like short-term U.S. Treasury bills.
Safe and accessible.
Exactly. And he tells this really sobering story about a friend in Russia, Sergei.
Oh, yeah.
Sergei didn't have a big enough risk-free buffer, got hit by COVID fallout, then the economic impact of the Ukraine war,
Right.
financially wiped out, tragic. It's a stark lesson in self-reliance, having that safety net.
Wow. A powerful reminder of how quickly things can change. Absolutely need that cushion. Okay, then he moves on to debt. Yeah. Frames debt as a tool, not inherently evil, but needs careful handling. He talks about buying his first house with a mortgage.
Was he nervous about the debt?
Initially, yeah. Huge amount of debt felt scary. But understanding the moving parts, house prices, interest rates, help manage the fear. He also mentions the opportunity cost,
Meaning?
meaning the money used for a bigger down payment could have been invested in the stock market instead, maybe earn more. It's a trade-off. He even says owning a house with a mortgage is basically like making a bond trade.
That's counterintuitive. A house is bond trade.
Financially speaking, yeah. The rent you don't pay is like the yield. Interesting perspective, which flows naturally into talking about where money itself comes from.
The source of it all, the central bank.
Right. Money, he says, is basically an invention, a social agreement. And usually, the central bank, like the Fed in the U.S., has the monopoly on creating it.
Yeah.
The big question for them is always, how much money should we create?
Because their decision impacts everything.
Hugely. Printing more money, or tightening supply, directly affects jobs, the value of our savings. He clarifies, printing money isn't usually literal printing presses.
Right. It's electronic mostly.
Often, yeah. The Fed buys treasury bonds from banks, credits their accounts electronically, puts digital cash into the system. He points to the 1929 crash as partly caused by money being too tight.
So it's a tricky balance for the central bank.
Incredibly tricky. Too much money. Runaway inflation, currency loses value. Too little money. Economy contracts, recession. He also mentions credit as a sort of secondary money source, an echo of the central bank's actions. Lower rates lead to more borrowing, amplifying the effect. Visualizing that flow from the central bank out through credit helps understand the big picture.
It's complex, but yeah, seeing that flow makes sense. Okay, so central banks create money. How do we save it? He lists the main ways.
4 main buckets, basically.
Yeah.
Cash, which we covered as the emergency fund. Stocks owning pieces of companies. Bonds lending money to governments or companies. Commodities, raw materials like oil or gold. And real estate, which, again, he kind of links to bonds.
And each has different drivers, right? Stocks driven by earnings and PE ratios?
Right. PE is just price to earnings, how much people pay per dollar of profit. Bonds are about real yield, the interest rate minus inflation, and what people expect inflation to do.
Gotcha. Real yield is key.
Commodities are basic supply and demand. Real estate value is often linked to the rent it could generate its yield.
Okay, so multiple ways to save. Then the next step is combining them, building a portfolio.
Exactly. A portfolio is just your collection of assets, and the magic word is diversification. Spreading your risk. Don't put all your eggs in one basket.
Because different assets do well at different times.
Precisely. He uses an analogy. A steady 8–10% return year after year is usually better long-term than wild swings up and down. Compounding works better with consistency. He mentions Ray Dalio's all-weather portfolio concept.
All weather. Sounds robust.
The idea is to build a mix that does reasonably okay no matter what the economy is doing. High growth, low growth, high inflation, low inflation. He suggests a possible starting mix.
Like?
U.S. stocks, inflation-linked bonds, regular bonds, foreign stocks, commodities. But he's quick to add the disclaimer. This isn't investment advice. Investing always involves risk.
Standard disclaimer, yeah. Build a portfolio that can handle different storms. Does he talk about different investing styles?
Briefly touches on the 2 main schools, value investing and growth investing.
Value is like finding bargains.
Yeah, finding good companies that seem cheap compared to their real worth. Companies with moats, strong competitive advantages. Warren Buffett is the classic example.
Kangaroo.
That's chasing companies whose earnings and revenues are growing super fast, hoping that growth continues and drives the stock price way up. Julian Robertson was a big name there.
Each has risks, though.
Oh, yeah. Value looks cheaper as the price falls, which can be a trap in a downturn. Growth is often high risk, high reward, relies heavily on future expectations. His point is, understand market history, figure out your own approach, your own framework.
It's a learning process. Okay, so we're saving, investing. Inevitably, the big question comes up, how much is enough?
Yes, the enough question.
Yeah.
He admits the money anxiety often doesn't fully go away, even for the wealthy.
Why not?
Our definition of needs tends to expand as we get richer. Plus, maybe you feel a responsibility to help family or give back. He gives a simple retirement calculation.
Savings divided by years left needs to be more than annual expenses.
Basically, yeah. But he also acknowledges that deep survival instinct. We're kind of wired to want more than just a calculated minimum. Loss aversion is powerful.
That tension again, security versus wanting more. And he brings up something critical for the long haul, health.
Huge point. Health is wealth, emphatically. He talks about his own growing realization. Sleep, exercise, nutrition, social connection, they're fundamental.
Not just nice to haves, essentials.
Absolutely. He even mentions vitamin N.
Yeah, vitamin N.
The ability to say no, setting boundaries to protect your well-being. His point is powerful. What good is financial freedom if you don't have the health to enjoy it?
So true. Physical and mental health are the foundation. Okay, as we navigate all this, he has a warning about experts, right?
Yeah, be wary of anyone claiming to be the money sage, including himself, he says.
How do you spot the unreliable ones?
Look for inconsistencies. Look for lies. Those reveal character, he suggests. Filter out the scammers.
Good advice. And then he hits on a major, often ignored flaw in retirement planning.
The big one. We don't know how long we'll live.
Right. The lifespan uncertainty kind of blows up the calculations.
Totally. We plan based on averages, but our own timeline is unknown. He tells that sad story about his colleague.
Retired early, died soon after.
Yeah. Highlights the paradox perfectly. Plan for a long life, but you might live a short one. Or vice versa.
It's that constant balance again, planning for the future while living now. He had his own shift in perspective around age 50.
Big time. Started calculating his remaining months, realized how precious time was.
And that led to a change.
Led him to quit the high-paying hedge fund job. Decided focusing on what do I think is true was more important than navigating corporate life. He stresses adjusting spending as you age, but also avoiding getting stuck in ruts.
Keep evolving.
Yeah, and he brings it back beautifully at the end. The whole point of money isn't to create constant anxiety. It's supposed to enable a fuller experience of the world.
A means to an end, not the end itself. So wrapping up this dive into Podolsky's book, what are the big takeaways for you?
I think it's that blend. You need the practical financial know-how, sure, but you also have to understand your own emotions, the societal pressures, and just accept the inherent uncertainty of it all.
It's not just about spreadsheets.
Not at all. It's about your relationship with security, risk, your values, aligning money with what actually matters to you.
Well, hopefully this conversation gave everyone listening a good shortcut to those insights, some useful perspective on their own money situation without the overwhelm.
Yeah, we've really just scratched the surface of what Podolsky covers. Maybe it's got people thinking about their own money cage, how they navigate it.
Definitely food for thought. What resonated most? What questions does it spark for further exploration? That's something for everyone to consider.